There is a word, a single syllable that separates the architect of a fortune from the participant in a lottery. It is not a word of action, of ambition, or of acquisition. It is not buy or more or now. It is a word of profound restraint, of intellectual honesty, and of immense silent power. It is the shortest, simplest, and yet most difficult word to master in the entire vocabulary of finance and in the language of a well-lived life. That word is no. In a world that is engineered to overwhelm you, to seduce you with endless opportunity, to trigger your fear of being left behind, the ability to utter this simple word is not a sign of passivity. It is a declaration of war. It is the active, aggressive, and relentless defense of your most precious assets, your capital, your time, and your focus. The common investor, the entrepreneur caught in the frantic churn of the everyday, believes that success is a function of the number of things they say yes to. More deals, more projects, more stocks, more meetings. They see their activity as a proxy for progress. Warren Buffett, the man who has compounded capital at a rate that defies financial gravity for over 60 years, understands the opposite to be true. His success is not built on the few things he said yes to. It is built on the foundation of the tens of thousands of things he has said no to. He has said no to industries he didn't understand. No to deals that were merely good but not great. No to market manias that seduce the rest of the world, and no to the incessant drumbeat of Wall Street that demands constant action. This is not a lesson in simple contrarianism. It is a masterclass in the architecture of a superior mind. It is a system for navigating a world of infinite information and finite attention. By saying number 99.9% of the time, you are not closing doors. You are building a fortress that protects your capital from erosion, that shields your mind from the poison of distraction, and that allows you to conserve your energy for the one battle, the one investment, the one opportunity that truly matters. Today, we are not just going to talk about this principle. We are going to deconstruct it, piece by piece, until it becomes a part of your own mental operating system. We will explore the 5 pillars that hold up this fortress of no, and by the end of this journey you will possess the framework to silence the noise, cure the fear of missing out, and transform your financial future not by doing more, but by aggressively, intelligently, and profitably doing almost nothing. This is the final promise of radical selectivity. The first pillar, the very foundation upon which this fortress is built, is the most misunderstood asset in the world of business and investing. It's not money. It's not connections. It is the finite, fragile, and immensely powerful resource of human focus. Buffett understands that cognitive capital is far more valuable and far scarcer than financial capital. His relentless use of the word no is, first and foremost, a strategy to protect this cognitive capital, creating what can only be described as a fortress of focus. To truly grasp this, we must travel back in time and step into a private conversation, a moment of mentorship between a billionaire and his trusted pilot. The pilot's name was Mike Flint. He had been flying for Buffett for a decade, a position of immense trust, and one day he was talking to his boss about his career goals, about the things he wanted to achieve in his life, outside of being a pilot for one of the world's wealthiest men. Buffett listened, then offered him a simple exercise. "Mike," he said, "I want you to get a piece of paper and write down the top 25 things you want to accomplish in your life." Flint was diligent. He took the task seriously, spending time thinking about his career aspirations, personal development goals, and family ambitions. He came back to Buffett with his list of 25 carefully considered life goals. Buffett looked at the list and then gave the second instruction. "Now, Mike," he said, "I want you to review that list and circle the 5 most important goals, just 5. This was much harder. It required painful trade-offs. To elevate one goal meant to demote another. After considerable thought, Flint returned with his list. He had his top 5, the absolute core of his life's ambition. Buffett looked at the 2 lists and asked, "So what are you going to do with the other 20? Flint replied with the logic that 99% of the world would use. Well, the top 5 are my primary focus, but the other 20 are still very important to me. I'll work on them as I have time. They are the things I'll get to on the weekends and in the evenings. They're not as urgent, but I still plan to give them a dedicated effort. Buffett's response was immediate and cut right to the heart of his entire philosophy. "No, Mike, you've got it all wrong," he said. "The 20 things you didn't circle just became your avoid-at-all-cost list. No matter what, these things get none of your attention until you have succeeded with your top 5. This story, now famously known as Buffett's 25-5 rule, is the single greatest parable for understanding the power of no. He wasn't just telling his pilot to say no to bad ideas, he was teaching him the far more difficult and powerful lesson of saying no to good ideas. The 20 items on Flint's list were not distractions in the typical sense. They were worthy goals, attractive ambitions. But in the calculus of a master of focus, a good idea is the most dangerous enemy of a great one. They are seductive enough to demand your time and energy, but they lack the profound impact of your absolute top priorities. They are the agents of mediocrity, guaranteeing you make a little progress in 20 directions, but never achieve a breakthrough in the one direction that truly matters. Buffett's no is not a passive rejection. It is an active, strategic culling. It is the recognition that every ounce of energy spent on goal number 6 is a direct theft from goal number 1. This anecdote is not just a clever productivity hack. It is a manifestation of a deep psychological principle that governs high performance. The concept is known as cognitive load theory. At its core, the theory states that the human brain, specifically our working memory, has a strictly limited capacity. Think of it like the RAM in a computer. You can only run so many demanding programs at once before the entire system slows down, starts to lag, and eventually crashes. Every piece of information we process, every decision we make, from choosing what to eat for breakfast to analyzing a complex balance sheet, consumes a piece of this finite cognitive bandwidth. The state of decision fatigue is the inevitable result of exceeding this capacity. It's a well-documented phenomenon where the quality of an individual's decisions deteriorates after a long session of decision-making. Judges, for example, have been shown to grant parole more frequently in the morning than in the afternoon, after a long day of hearing cases. Their cognitive resources have been depleted. Buffett's entire life is structured to combat this. He understands that his primary job, the source of all his value, is to make a handful of high-quality, high-consequence capital allocation decisions per year. That's it. To do that effectively, he cannot afford to waste his precious cognitive RAM on anything else. His empty diary is famous. He has very few meetings. He doesn't have a computer on his desk. He spends the vast majority of his day, up to 80% of it, just sitting and reading. He is not being lazy, he is being ruthless. He is saying no to the endless stream of emails, meetings, news alerts, and conference calls that the modern CEO or investor considers work. He recognizes that this activity is not work. It is cognitive clutter. It is the enemy of clear thought. The average person's brain is a browser with 100 tabs open. There's a tab for a news article they half read, a tab for a stock they are watching, a tab for a social media feed, a tab for a new business idea, a tab for a political outrage. Each tab consumes a little bit of mental energy. The system is constantly worrying, but it's not actually processing anything deeply. Buffett's brain is a single, clean interface focused on one program at a time. The 25-5 rule is his firewall. It's the algorithm that decides which programs are even allowed to launch. By saying no to the 20 good ideas, he is closing the unnecessary tabs, freeing up all of his cognitive RAM to be dedicated to the 5 that can change the game. This isn't about time management, it's about energy management. It's the CEO mindset applied to your own life. You are the CEO of your own capital and your own attention. Your primary job is to make a few great decisions, not 1,000 good ones. So how do you translate this into a practical, applied mental model? How do you build your own fortress of focus? The blueprint is the 25-5 rule itself, applied with disciplined regularity to every aspect of your financial and professional life. Let's make this granular. First, for your career or business. Take a full day, not just an hour, and replicate Mike Flint's exercise. Write down the 25 most important professional goals you have. Be ambitious, be specific. Get a promotion is weak. Become Vice President of Operations by developing a new logistics system that cuts shipping costs by 15% within 24 months is strong. Once you have your 25, the painful part begins. You must, without compromise, circle only 5. These are now your prime directives. The other 20 go onto your avoid-at-all-cost list. This list should be physically real. Write it down and post it somewhere you can see it. It is your shield. When a new opportunity comes across your desk, a new project, a new collaboration, you must first check it against your list of 5. If it does not directly and powerfully serve one of those 5 goals, the answer is an immediate and polite no. Then, you check it against your avoid-at-all-cost list. If it resembles anything on that list, the answer is a resounding, unapologetic no. Now let's apply this to portfolio management, which is where this becomes a direct tool for wealth creation. Step 1. Create your universe. List the 25 companies you would most like to own. These are businesses you admire, that you feel you understand. This is your starting pool. Step 2. The great culling. You must now force yourself to select the 5 best ideas from that list. This is not a simple task. It requires you to develop a strict set of criteria. You are no longer just looking for good companies, you are looking for the absolute best opportunities available to you. Your criteria might include a non-negotiable margin of safety, a certain return on equity, a debt-to-equity ratio below a certain threshold, and a management team with a proven track record of intelligent capital allocation. Step 3. Create your watch list and your too-hard pile. Your top 5 are the only companies you are actively researching, the only ones you are dedicating your precious cognitive capital to understanding at a profound level. The other 20? They are not your next best ideas. They are now, for all intents and purposes, on your avoid-at-all-cost list. You do not check their stock price. You do not read every news article about them. You have made the strategic decision that they are a distraction from the real work of mastering your top 5. This process transforms you from a passive collector of stocks into an active, focused business analyst. It forces an investment discipline that is almost impossible to achieve when you are swimming in a sea of endless information. To fully appreciate the power of this focused approach, we must examine its antithesis, the path walked by the 99%. This is the path of the busyness trap. The modern world glorifies being busy. The entrepreneur with a calendar packed with back-to-back meetings, the investor with multiple screens flashing quotes and news feeds, the employee who answers emails at 11 p.m. These are our cultural heroes. They are seen as driven, hardworking, and indispensable. Buffett's philosophy reveals this for what it is, a cognitive catastrophe. The 99% are trapped in a cycle of reactive, shallow work. They confuse activity with accomplishment. The investor who subscribes to 5 different financial news services, watches hours of market commentary on TV, and maintains a spreadsheet with 100 stocks they are tracking, feels like they are doing the work of a serious investor, but they are not. They are a professional information gatherer, not a decision maker. Their focus is spread so thin that their analysis of any single company is, by necessity, superficial. They know the recent price action, the latest earnings headline, and the popular narrative. They do not know the 10-year history of the company's return on invested capital, the incentive structure of the CEO's compensation package, or the unit economics of its core product. They say yes to every new piece of information, and in doing so, they say no to the deep, uninterrupted thought required for true insight. This leads directly to chasing trends. When a new sector gets hot, like AI or electric vehicles, they feel compelled to participate. They don't have time to deeply understand the technology or the competitive landscape of 20 different companies, so they buy a basket of the most popular names, hoping to catch the wave. They are acting out of a fear of missing out, driven by the noise they have allowed to flood their consciousness. Their portfolio becomes a messy, incoherent collection of story stocks and recent winners, an artifact of what was popular last quarter. There is no central philosophy, no high conviction, just a frantic attempt to be everywhere at once, which is the guaranteed path to arriving nowhere of consequence. The result is a portfolio that churns constantly, racking up transaction fees and taxes, and ultimately achieving returns that are, at best, mediocre. They are running on a hamster wheel, mistaking the speed of the wheel for forward progress. The direct financial connection of Buffett's fortress of focus is both profound and quantifiable. It manifests in two critical areas: cost reduction and alpha generation. First, cost reduction. The costs of a scattered, unfocused investment approach are immense, though often hidden. The most obvious is transaction costs. The busy investor is always trading, trimming a position here, adding a new one there, constantly reacting to news. Each trade incurs a commission and, more insidiously, a bid-ask spread. Over years, this friction is a significant drag on returns. Then there are taxes. A focused, long-term approach that involves very little selling naturally defers capital gains taxes, allowing your capital to compound on a pre-tax basis for far longer, a massive and often underestimated advantage. But the most significant cost is cognitive. What is the financial value of 1 hour of your deepest, most uninterrupted concentration? For a high-level executive or a serious investor, that value could be thousands or even tens of thousands of dollars. If that hour is spent sifting through irrelevant news or tinkering with a minor position in your portfolio, the opportunity cost is staggering. That was an hour you could have spent reading an annual report that revealed a critical flaw in your main holding, or identifying the next great, life-changing investment. By saying no to the 99% of inputs that don't matter, you are preserving this high-value time for the 1% of activities that generate all the returns. This is the essence of a CEO mindset. Second, alpha generation. Alpha, in financial terms, is the return you generate above and beyond the market average. It is the prize for superior insight, and superior insight is born of focus. By concentrating your mental energy on only a handful of companies, you can achieve a level of understanding that the superficial, scattered investor can never hope to match. You will understand the business so well that when the market panics over a short-term headline, you will have the conviction to buy more, not sell. When the company makes a strategic acquisition, you will be able to independently assess whether it creates or destroys value, rather than relying on the opinions of analysts. This informational and analytical edge, cultivated through intense focus, is the only sustainable source of alpha in a competitive market. You don't get it by knowing a little about a lot of things, you get it by knowing everything about a few things. The fortress of focus, therefore, is not a passive defense. It is the essential platform from which you launch your most profitable attacks. It ensures that when you finally do say yes, it is with the full, undivided force of your capital and your intellect. Having built the outer walls with the fortress of focus, we now move to the second pillar, the internal architecture that gives the structure its unyielding strength. This is the principle that transforms the abstract idea of focus into a concrete mathematical rule of engagement. It is Buffett's famous and radically simple analogy, the 20-slot rule. This concept forces a mindset of extreme scarcity and, in doing so, guarantees a higher quality of decision-making. Imagine, as Buffett proposed in a lecture to a group of business students at Columbia University, that upon graduation you were given a special punch card. This card has only 20 slots on it, and it represents every single investment you are allowed to make for the rest of your life. Every time you buy a stock, you have to punch a hole. Once you've punched all 20 holes, you're done. You can't make any more investments. Think about the psychological gravity of that. The immediate effect is that the very act of investing is elevated from a casual, frequent activity to a momentous, rare event. You wouldn't dream of using one of your precious 20 slots on a speculative bet, a hot tip from a friend, or a company you've only researched for a few hours. The stakes are too high. Buffett explained the consequence. Under those rules, you'd really think carefully about what you did, and you'd be forced to load up on what you'd really thought about, so you'd do much better. This is not just a clever thought experiment, it is a direct reflection of how Berkshire Hathaway itself has been built. If you examine the history of the company, its immense wealth was not created by hundreds of good ideas. It was created by a handful of truly titanic, high-conviction decisions. In 1964, when American Express was nearly bankrupted by the salad oil scandal and the market panicked, convinced the company was finished, Buffett didn't just take a small position. He famously went to restaurants and businesses to see if people were still using their cards and travelers' checks. Convinced the brand was intact, he invested 40% of his partnership's capital into the company. He punched his slot, and he punched it hard. When he bought See's Candies in 1972 with his partner Charlie Munger, it became the prototype for their ideal business, one with a powerful brand, pricing power, and low capital requirements. They didn't just buy a few shares, they bought the whole company. His investment in Coca-Cola in 1988 was another defining moment. After the market crash of 1987, he saw one of the world's greatest, most predictable businesses trading at a ridiculously cheap price. He invested over $1 billion, making it Berkshire's largest single holding. In each case, the pattern is the same. Years of saying no, of patient observation, followed by a moment of decisive, overwhelming force when a truly exceptional opportunity presented itself. The 20-slot rule is the mental discipline that makes this possible. It forces you to say no to the merely interesting and wait for the mathematically unassailable. The psychological power of this mental model is rooted in two potent cognitive biases that it masterfully harnesses for your benefit: the scarcity heuristic and the commitment and consistency bias. The scarcity heuristic is a mental shortcut our brains use that places a higher value on things that are scarce and a lower value on things that are abundant. It's why limited edition products command premium prices and why we are more motivated to act when an opportunity is about to disappear. In the world of investing, the number of potential opportunities feels infinite. There are thousands of stocks, endless strategies, and a constant stream of new ideas. This abundance cheapens the act of decision-making. Because you can always make another trade tomorrow, the trade you make today feels less significant. The 20-slot punch card brilliantly inverts this. It artificially manufactures scarcity. Your investment decisions are no longer abundant. They are a finite, precious resource. Your brain, thanks to the scarcity heuristic, automatically assigns a much higher value to each decision. This triggers a cascade of positive behaviors. You become far more diligent in your research. You demand a much higher standard of quality for any potential investment. You are no longer looking for a reason to say yes. You are desperately searching for a reason to say no, to conserve your precious slot for something even better. The second principle at play is the commitment and consistency bias. This is our deep-seated psychological need to be consistent with things we have already said or done. Often this bias works against investors. They make a hasty investment, and then, to remain consistent with their initial decision, they hold on to it even when evidence mounts that it was a mistake. They invent new reasons to justify their original choice, falling victim to confirmation bias. But with the 20-slot rule, this bias becomes a powerful ally. Because the initial decision to punch a slot was made with such extreme care and diligence, the commitment to that decision is well-founded. When the market inevitably becomes volatile and the stock you bought drops 20%, the untrained investor panics. Their initial conviction was shallow, so it shatters easily. But the punch card investor's conviction is profound. They have already done the exhaustive work. The commitment and consistency bias kicks in, not as a trap, but as a source of strength. It encourages them to stick with their well-researched thesis, to weather the short-term storm, and to think like a true business owner rather than a renter of stocks. It transforms a bug in our mental software into a powerful feature for high-conviction investing. Translating this powerful concept into an actionable blueprint for your own portfolio management requires a deliberate and disciplined approach. We will call it the virtual punch card portfolio. This is a system you create not just in your mind, but in a physical or digital journal that serves as a constant reminder of the stakes. Step 1. Define your lifetime card. Be realistic. You are likely not a full-time investor like Buffett, so perhaps 20 slots is too few. Choose a number that feels both realistic and uncomfortably restrictive. Maybe it's 25, 30, or 40. The exact number is less important than the fact that it is fixed. This is the total number of new, core positions you will initiate for the rest of your investing life. This number does not include broad market ETFs or mutual funds you might use for core asset allocation, but it applies to every individual stock or concentrated investment you choose to make. Step 2. Architect your punch criteria. This is the most critical step. Before you even consider your first investment, you must define the non-negotiable set of rules that a company must meet before it qualifies for one of your precious slots. This is your personal investment constitution. Write it down. It should be a checklist of brutal hurdles. For example, your criteria might be: 1. The business must be within my predefined circle of competence. 2. It must have a durable competitive advantage, a moat. 3. It must have at least 10 years of consistent high returns on invested capital. 4. Management must be honest, capable, and have significant skin in the game. 5. The balance sheet must be pristine, with low debt. 6. I must be able to buy it at a price that offers a significant margin of safety to my conservative estimate of its intrinsic value. The default answer to any new idea is a resounding no. An idea must fight and win its way through this gauntlet to even be considered. Step 3. Track your punches. Create a section in your journal for your punch card. Every time you make a new investment that meets your criteria, you document it. You write down the date, the company, the price, and a summary of the thesis. You then physically mark off one of your slots. Slot 3 of 30 punched. This simple act creates a powerful psychological barrier. When you are tempted to chase a hot stock or act on a flimsy tip, you are forced to confront the question: is this idea so good, so overwhelmingly compelling, that it is worth 1/30th of my entire investing future? The answer almost always will be no. This system forces patience. It mandates diligence. And it is the ultimate cure for the kind of frivolous trading that destroys wealth over time. To see the genius of this approach, we must examine its antithesis, the path of the 99%, which can be summed up in a single, devastating word coined by the legendary investor Peter Lynch: diversification. This is the practice of over-diversifying a portfolio to the point where the potential for meaningful gains is completely eliminated. The common wisdom, often peddled by financial advisors who benefit from complexity, is that diversification is the only free lunch in finance. Spreading your money across hundreds or even thousands of stocks, they argue, reduces risk. While this is true to an extent, it is a truth that has been twisted into a doctrine of guaranteed mediocrity. The average investor who owns a typical mutual fund doesn't own a carefully selected portfolio of businesses. They own a sprawling, unfocused index of the market, minus a hefty management fee. They have diversified away the risk of any single company blowing up, but they have also diversified away any chance of one of their holdings producing a life-changing return. They have achieved safety, but at the cost of prosperity. The diversifier operates under the illusion of being sophisticated. They might own a dozen different mutual funds: a large-cap growth fund, a small-cap value fund, an international fund, an emerging markets fund. They feel like they are constructing a complex, intelligent portfolio, But when you look under the hood, these funds often have massive overlaps, and the net result is that the investor owns a tiny, inconsequential piece of 1,000 different companies. They know the name of the fund, but they couldn't name the top 5 businesses within it or explain their competitive advantages. This is not investing, it is collecting. It is outsourcing your thinking and, in exchange, receiving the market's average return, which is then eroded by fees and inflation. The most dangerous form of diversification is when investors try to do it themselves. They hear about 50 different promising stocks, and, fearing to miss out on any of them, they buy a little bit of each. Their portfolio becomes a cluttered garage sale of mediocrity. Even if they are right, and one of those 50 stocks turns into a 10-bagger, the impact on their overall wealth is negligible. A 2% position that grows tenfold only adds 18% to the total portfolio value. It's a mathematical trap. The punch card investor avoids this trap by embracing the opposite philosophy: concentration. They understand that true wealth is not built by owning a little bit of everything, but by owning a lot of a few extraordinary things. The direct financial connection of the 20-slot rule is the most powerful force in all of finance, the mathematics of concentrated compounding. The numbers are unforgiving and illuminating. Let's take 2 investors, both starting with a $100,000 portfolio. Investor A is the diversifier. They own 50 stocks, with 2% of their capital in each. Investor B is the punch card investor. They have done exhaustive research and have concentrated their capital into just 5 carefully selected stocks, with 20% of their capital in each. Now let's say both investors are brilliant stock pickers and they each manage to find one company that doubles in value over the next year. For investor A, their 2% position becomes a 4% position. Their total portfolio value goes from $100,000 to $102,000, a 2% gain. It's barely noticeable. For investor B, their 20% position becomes a 40% position. Their total portfolio value goes from $100,000 to $120,000, a 20% gain. This is the difference between making a living and building a fortune. The risk, of course, is that if investor B is wrong about one of their companies, the impact is much larger. This is why the 20-slot rule is not a call for reckless concentration. It is a call for obsessive diligence prior to concentration. The scarcity of the slots forces a level of research that dramatically reduces the odds of making a catastrophic mistake. This is the mindset of private equity and of the world's most successful wealth management firms. They do not place small bets on hundreds of companies. They perform months of intense due diligence and then make massive, concentrated investments in a handful of businesses they understand inside and out. They are playing a different game. The financial transformation comes from understanding that volatility is not the same as risk. Risk, as Buffett defines it, is the chance of a permanent loss of capital. A portfolio of 50 companies you don't understand is far riskier, in his view, than a portfolio of 5 companies you know, as well as you know your own family. The 20-slot rule is a system for minimizing true risk while maximizing the mathematical power of your best ideas. It is the framework that allows you to say no to the siren song of diversification and yes to the focused, disciplined, and immensely profitable path of high-conviction investing. With the fortress walls established and the internal architecture of scarcity in place, we arrive at the third pillar, the gatekeeper. This is the principle that determines what is even allowed to be considered for a precious punch on your card. It is perhaps Buffett's most famous contribution to the lexicon of value investing, the circle of competence. This is not merely an idea. It is an unbreachable moat of intellectual honesty that protects an investor from the single greatest destroyer of capital, themselves. The concept is brutally simple. Every investor, through their unique experience, study, and career, develops a deep understanding of certain industries and business models. This is their circle of competence. Outside of that circle lies a vast universe of businesses, technologies, and financial instruments that they do not truly understand. The rule, according to Buffett and Munger, is the most important in all of investing. You must never, ever stray outside that circle. To illustrate the sheer iron-willed discipline this requires, we must go back to the late 1990s, to the height of the dot-com bubble. It was a period of absolute mania. Companies with no revenue, no profits, and often no viable business plan were going public and seeing their stock prices multiply overnight. Technology was the new paradigm, and anyone who questioned it was dismissed as a relic, a dinosaur who just didn't get it. And the chief dinosaur, according to the media and Wall Street, was Warren Buffett. While the Nasdaq was soaring, Berkshire Hathaway's stock was flat, even declining. The pressure on him was immense, not just from the outside world, but from his own shareholders. Barron's, the influential financial weekly, ran a cover story in 1999 with the headline, "What's Wrong, Warren?" The article questioned whether his value investing principles were dead in the new economy. At the annual Sun Valley Conference, an elite gathering of tech and media moguls, Buffett was practically ridiculed for not owning any technology stocks. He was sitting in the epicenter of the boom, surrounded by the people getting fabulously rich from it, and he calmly, stubbornly said no. He didn't say no because he thought all tech companies were bad investments. His reasoning was far more profound and instructive. He said no because he did not feel he could confidently predict what the competitive landscape and, more importantly, the cash flows of these businesses would look like in 10 or 20 years. He couldn't look at a company like Qualcomm or Cisco and, with the same certainty that he could with Coca-Cola or Gillette, map out their future earnings power. They were outside his circle of competence. He admitted it, openly and without shame. It wasn't a confession of ignorance. It was a declaration of intellectual discipline. He chose to look like a fool in the short term, rather than be a fool in the long term. And when the bubble burst in 2000 to 2002, wiping out trillions of dollars of speculative wealth and destroying countless portfolios, Buffett's discipline was vindicated. He hadn't just avoided losses, he had preserved his capital and his sanity, ready to deploy it when the world returned to its senses. His no was not a market call, it was an act of profound self-awareness. The psychological principle that Buffett's circle of competence so elegantly neutralizes is one of the most pervasive and dangerous cognitive biases of all, the Dunning-Kruger effect. Coined by psychologists David Dunning and Justin Kruger, this bias describes a phenomenon where individuals with low ability at a task systematically overestimate their own ability. In essence, they are too incompetent to recognize their own incompetence. The world of investing is a perfect breeding ground for this effect. A beginner investor buys a stock, it goes up thanks to sheer luck in a bull market, and they immediately attribute the success to their own genius. Their small amount of knowledge gives them a massive, unearned dose of confidence. They are standing atop what Dunning and Kruger called Mount Stupid, the peak of overconfidence that comes with a little bit of knowledge but no real expertise. From this perilous peak, the investor feels empowered to have an opinion on everything. They start making pronouncements about biotech, cryptocurrency, and geopolitical macro trends, all based on a few articles they read online. They have drifted far from any shore of genuine competence, out into a vast ocean of things they don't understand, and they don't even have the self-awareness to know they are drowning. The circle of competence is a powerful antidote to this. It is an exercise in intellectual humility. It forces you to draw a line in the sand, to explicitly define what you don't know. This is a crucial distinction. Most people focus on what they know. The masters focus on the boundaries of their knowledge. By refusing to play in games where he doesn't have an edge, Buffett avoids the Dunning-Kruger trap entirely. His no is a filter that keeps him away from Mount Stupid. He is content to operate in the valley of despair that comes after realizing how little you know, and then slowly, deliberately climb the slope of enlightenment within his chosen fields. This is the core of true behavioral finance. It's not about predicting the market, it's about understanding and controlling yourself. Buffett's greatest advantage is not his IQ, which is formidable, but his temperament. He has a near superhuman ability to be honest with himself about his own limitations. Saying no to a tempting idea that lies outside his circle isn't a sign of weakness, it's the ultimate sign of intellectual strength. The applied mental model for building and respecting your own circle of competence is a practical exercise in self-assessment. We can call it mapping your circle. It's a process that requires brutal honesty, not aspiration. Step 1. The blank page. Take a physical sheet of paper and a pen. In the center, draw a circle. This circle represents the boundary of your deep, practical, and intuitive knowledge. This is not a list of your interests or hobbies. It is a list of the industries and business models where you could hold your own in a debate with a seasoned professional. Step 2. Populate the interior. Inside the circle, start writing. What industries have you worked in for years? What products or services do you understand at a granular, first principles level? Maybe you're a software engineer who deeply understands enterprise SaaS business models. Write that down. Maybe you're a doctor who understands the healthcare system, pharmaceuticals, and medical devices. Write that down. Maybe you're a lifelong, obsessive consumer of retail brands, and you understand the psychology of branding and logistics better than anyone you know. Write that down. Be strict. If you have to Google how does this business make money, it does not belong inside your circle. For most people, this circle will be alarmingly small. That is not a failure. That is the beginning of wisdom. Step 3. Acknowledge the outer universe. Everything else, every other industry, technology, and business model exists outside that circle. This is your too hard pile. This is the universe of things you will say no to. It is not your job to have an opinion on biotech if you are a banker. It is not your job to predict the price of oil if you are a software developer. Your job is to say I don't know and move on. Step 4. The expansion project. The goal is not to jump outside your circle to chase a hot trend. The goal is to either go deeper, train within your circle, becoming the world's leading expert on the 2 or 3 industries you already know, or to slowly, deliberately, and over many years, expand the perimeter of your circle through intense, focused study. You might decide you want to understand the insurance industry. That doesn't mean you buy insurance stocks. It means you spend the next 2 years reading every book, every annual report, and every trade publication on the subject, until it can genuinely be moved inside your circle. The circle of competence is not a static prison. It is a dynamic home base that you build and fortify over a lifetime. The antithesis of this disciplined approach is the expert in everything syndrome, a malady that afflicts the vast majority of market participants. These are the investors who are constantly chasing narratives. One week, they are an expert on lithium mining because they read a compelling article about electric vehicles. The next week, they are an authority on blockchain technology because they watched a YouTube video. Their research process is a mile wide and an inch deep. They are swayed by stories, not by numbers. They suffer from a terminal case of FOMO, believing that they must have a stake in every new, exciting trend, lest they get left behind. Their portfolio is a reflection of this intellectual chaos. It contains a little bit of crypto, a few shares of a gene-editing startup, a speculative cannabis stock, and a stake in a company trying to build flying cars. Each position is a lottery ticket on a popular narrative. There is no unifying principle, no deep understanding, just a desperate hope that one of these stories will come true. The dot-com bust provides the ultimate, tragic case study of this syndrome. Millions of ordinary people, teachers, doctors, plumbers, who had zero competence in evaluating technology businesses, poured their life savings into companies with names like Pets.com and Webvan. They didn't understand the technology, the business models, or the insane valuations. They only understood one thing: their neighbor was getting rich, and they were missing out. They ventured leagues outside their circle of competence, driven by the 2 most dangerous emotions in investing: greed and envy. When the inevitable collapse came, they were left with nothing but worthless stock certificates, and a painful lesson in the importance of sticking to what you know. They were not victims of the market, they were victims of their own intellectual overreach. Their failure to say the simple, powerful words, "I don't understand this, so I will say no." The direct financial connection of adhering to the circle of competence is the most important concept in all of investing. Superior risk management. The single biggest threat to long-term compounding is not missing out on a big winner, but suffering a catastrophic loss. A 50% loss in your portfolio requires a 100% gain just to get back to where you started. A 90% loss, as many dot-com investors experienced, requires a 900% gain, a feat that is nearly impossible. The circle of competence is the single most effective tool for preventing these wealth-destroying permanent losses. By only investing in businesses you deeply understand, you dramatically reduce the chances of being blindsided. You can more accurately assess the risks. You can see the competitive threats coming. You can evaluate management's decisions with a critical eye. When you invest outside your circle, you are effectively gambling. You don't know what you don't know. The risks are hidden from you, lurking beneath the surface of a compelling story. The financial result of this discipline is not necessarily that you will always pick the biggest winners. Instead, it is that you will almost certainly avoid the biggest losers. This creates a much smoother, more resilient equity curve for your portfolio. Your drawdowns during market panics will be shallower because you own robust businesses you understand, not speculative stories that evaporate when fear takes over. This preservation of capital during the bad times is the secret sauce of long-term outperformance. By saying no to the vast majority of the market that lies outside your expertise, you are not limiting your upside. You are building an indestructible foundation for your wealth. It's the financial embodiment of the old adage. It's not about timing the market, but about timing the markets you truly understand. We have now fortified our focus, embraced scarcity, and defined the boundaries of our knowledge. The fourth pillar addresses the very process of decision-making itself. It is a powerful mental model that weaponizes the word no to combat the most insidious behavioral biases that plague investors. This is the inversion principle. Instead of asking the conventional question, "How can this investment succeed?" a master thinker like Buffett inverts the problem and asks, "How can this investment fail?" This simple flip of the question transforms the entire analytical process from one of optimistic speculation into one of rigorous, paranoid risk assessment. The default answer becomes no, and any idea that graduates to a yes has survived a trial by fire. A perfect illustration of this principle in action was Buffett's investment in PetroChina in the early 2000s. At the time, very few Western investors were looking at Chinese state-owned enterprises. The narrative was complex, filled with political risk and accounting opacity. The conventional analyst, focused on the upside, would have tried to build a complicated model predicting the future price of oil, Chinese economic growth, and global energy demand. It would have been a speculative exercise in forecasting the unknowable. Buffett inverted the problem. As he described in his 2007 shareholder letter, he didn't start by asking how much money PetroChina could make. He started by reading the annual report and asking a much simpler, more powerful question. What is the entire business worth? He read about their oil and gas reserves, their refining capacity, and their chemical operations. Using simple, conservative metrics, he concluded that the total value of the company was, at a bare minimum, $100 billion. He then looked at the stock market and saw that its total market capitalization was a mere $35 billion. The market was selling him the entire business for about 1/3 of its obvious stated value. At that point, the decision became trivial. He didn't need to be a genius at predicting oil prices. He didn't need a special insight into Chinese politics. The investment wasn't based on a forecast of what could go right. It was based on the near impossibility of it going horribly wrong. He was buying dollar bills for 35 cents. The risk of permanent capital loss was minuscule. He invested nearly $500 million, and a few years later sold the position for around $4 billion. The genius was not in the prediction, but in the inversion. He relentlessly looked for the reasons this could fail, found none that were plausible relative to the price, and only then, with all the downside questions answered, did he say yes. This process of inversion is a direct and powerful countermeasure to one of the most fundamental principles of behavioral finance, loss aversion. As documented by the Nobel laureates Daniel Kahneman and Amos Tversky, for human beings, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This deep-seated evolutionary wiring has profound consequences for investors. It's what causes them to feel the agony of a stock market correction so acutely, leading to panic selling at the absolute worst time. It's also what makes them chase performance, buying stocks after they have already gone up, because the fear of missing out on further gains, a perceived loss, is so strong. Most investors are puppets to this bias, tossed around by their emotions. Buffett, by inverting his decision-making process, co-opts loss aversion and turns it into his greatest ally. His entire methodology is designed to front-load the pain of a potential loss. By asking, "How can this fail?" and "What are all the ways I could lose money on this deal?" he is forcing himself to confront the worst-case scenarios in the calm, rational environment of his office, not in the crucible of a market panic. He is essentially pre-experiencing the potential for loss. This process naturally favors inaction. The path of least psychological resistance is to say no, because A, no, guarantees you will not lose money. A, yes, opens the door to that possibility. Therefore, for an investment to overcome this inverted hurdle, the argument for it must be utterly overwhelming. It must be so cheap, so safe, and so obvious that the potential for gain massively outweighs any rational fear of loss. This aligns his analytical process with our core psychological wiring. While the average investor is trying to find reasons to be optimistic so they can get the thrill of a potential gain, Buffett is rigorously trying to find reasons to be pessimistic to satisfy his deep-seated instinct to avoid pain. It's a system designed to produce a tiny number of incredibly safe and profitable decisions. To apply this powerful inversion technique to your own executive decision-making, whether in business or in your portfolio, you can use a structured mental model known as the pre-mortem analysis. This framework, popularized by the psychologist Gary Klein, is inversion in action. Step 1. Imagine failure. Before you make any significant commitment of capital or resources, whether it's buying a stock, launching a new product, or making a strategic hire, you must convene your team, or just yourself, and begin with a powerful assumption. Fast forward in your mind 1 year into the future and assume that the project has failed utterly and catastrophically. The stock you bought is down 80%. The product launch was a disaster. The new hire was a toxic influence who derailed the whole team. Step 2. Generate the reasons. Now, working backward from this imagined future, you must brainstorm every possible reason for this failure. This is not a time for optimism or for defending the idea. It is a time for productive paranoia. Write down everything that could have gone wrong. For an investment, the list might include: the competition released a superior product we didn't anticipate. The CEO, who we thought was a genius, made a foolish, value-destroying acquisition. A change in regulation completely upended the industry's economics. Our initial valuation was based on overly optimistic assumptions about growth that never materialized. Be specific and be brutal. Step 3. Analyze and mitigate. With this list of potential failure points in hand, you can now analyze the original plan with fresh eyes. How likely are these negative events? What can we do right now to mitigate these risks or build in resilience against them? Can we adjust our purchase price to account for a higher probability of competition? Does the CEO's past record on capital allocation give us confidence or pause? This process forces you to identify the weak points in your argument before you've committed a single dollar. Step 4. The ultimate filter. Only if, after this rigorous pre-mortem, you cannot construct a plausible and high-probability path to disaster, Do you even consider moving forward? This makes no, your default, rational, and safe position. Yes becomes the rare exception, a decision that has survived the most pessimistic assault you could throw at it. It is the ultimate tool for avoiding stupidity, which, as Charlie Munger often says, is more important than trying to be brilliant. The antithesis of this disciplined, inverted approach is what can be called narrative-driven investing. This is the path of the 99%. These investors don't start with risk. They start with a story. They fall in love with a compelling narrative. This company is disrupting an entire industry. This technology is going to change the world. This visionary CEO is the next Steve Jobs. The story is so seductive, so emotionally appealing, that it short-circuits their critical thinking. They focus exclusively on the potential upside, the dream scenario where the story comes true. They suffer from an extreme form of confirmation bias, actively seeking out information that supports their chosen narrative and dismissing any data that contradicts it. They never conduct a pre-mortem because the very idea of the story not coming true is too painful to contemplate. The meme stock phenomenon of recent years is a perfect, if extreme, example. The investment thesis for companies like GameStop or AMC was not based on fundamentals, valuation, or risk assessment. It was based entirely on a powerful, emotionally resonant narrative, a band of retail investors banding together to take on the Wall Street hedge funds. It was a classic David versus Goliath story. People who invested were not buying a piece of a business, they were joining a movement. They were buying a story. When you are driven by narrative, you ignore all the red flags that an inverted pre-mortem analysis would immediately uncover. The deteriorating business fundamentals, the absurd valuations disconnected from reality, the immense risk of being the last one holding the bag when the narrative shifts. Narrative-driven investing is a purely emotional exercise focused on what could go right. Inversion is a purely rational exercise focused on what could go wrong. One path leads to excitement, community, and ultimately, financial ruin. The other leads to quiet contemplation, discipline, and ultimately, enduring wealth. The direct financial connection of the inversion principle is the creation of the single most important concept in all of value investing, the margin of safety. Popularized by Benjamin Graham, Buffett's mentor, the margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. When you buy a company that you've calculated is worth $100 per share for only $60 per share, you have a $40 margin of safety. This gap is your protection. It's the financial cushion that absorbs the impact of bad luck, unforeseen negative events, or your own inevitable errors in judgment. The pre-mortem analysis is the process that demands a margin of safety. By focusing on everything that can go wrong, you naturally become unwilling to pay a high price for any asset. You will only say yes to a deal where the price is so low relative to the value that it already accounts for a host of potential problems. Buying PetroChina for $35 billion when it was worth $100 billion provided Buffett with a staggering $65 billion margin of safety. Even if oil prices fell, or the Chinese government made a poor decision, or his own valuation was slightly too optimistic, there was an enormous buffer to protect his capital from permanent loss. This shows up directly in your portfolio's performance. A portfolio built with a consistent margin of safety is inherently anti-fragile. When market panics occur and valuations collapse, your holdings, which were already cheap, tend to fall less than the overpriced glamour stocks. Furthermore, a large margin of safety provides not just protection, but also a source of powerful returns. Over time, the price of an asset tends to converge with its underlying value. By buying at a significant discount, you have two sources of return: the growth in the intrinsic value of the business itself, and the closing of the gap between the price you paid and that intrinsic value. Saying no to any investment that does not offer a significant margin of safety is the direct financial output of the inversion process. It is how you build a portfolio that is engineered to both survive failure and to thrive. We have now reached the final and perhaps most counterintuitive pillar of Buffett's philosophy of no. It is the principle that redefines the very nature of activity and passivity in investing. This is the pillar that values patience not as a virtue, but as a tangible, strategic asset. It is the understanding of the price of inaction, and how doing nothing is often the most profitable action you can take. Buffett's ability to say no culminates in his willingness to sit on enormous piles of cash, sometimes for years, waiting for the perfect opportunity. To the outside world, this looks like passivity, like a missed opportunity. To Buffett, this cash, this dry powder, is a coiled spring, ready to be deployed with immense force when the moment is right. The most dramatic example of this unfolded between the late 1990s and the depths of the 2008 financial crisis. During the dot-com mania, as we discussed, Buffett said no to everything. Berkshire's cash pile grew and grew, leading to criticism that he had lost his touch. The market was roaring, and he was sitting on the sidelines. He was inactive. After the bubble burst, he made a few investments, but remained largely cautious through the mid-2000s housing boom. Again, his cash pile swelled to tens of billions of dollars. He was saying no to overpriced acquisitions, no to risky debt instruments, and no to a market that seemed to have forgotten the meaning of risk. Then, in the fall of 2008, the world broke. Lehman Brothers collapsed, credit markets froze, and the global financial system teetered on the brink of apocalypse. Fear was absolute. Everyone was a forced seller, and there were no buyers, except one. In a matter of weeks, Warren Buffett, the man who had been doing nothing for years, became the most important investor in the world. His phone began to ring. First, it was Goldman Sachs, the premier investment bank, which was facing a crisis of confidence. Buffett agreed to invest $5 billion. Then came General Electric, a titan of American industry, which couldn't fund its day-to-day operations. Buffett invested $3 billion. Later, he would make massive investments in Bank of America and others. But look at the terms he was able to demand. He wasn't just buying common stock. For Goldman Sachs, he received preferred stock paying a staggering 10% annual dividend, hundreds of warrants that gave him the right to buy common stock at a fixed, low price in the future. It was a heads I win, tails I don't lose much proposition. He got these incredible one-sided deals for one reason and one reason only. He was the only person with cash. His years of saying no, of patiently waiting, had transformed Berkshire from a passive holding company into the lender of last resort for corporate America. His inaction had created the greatest investment opportunity of his lifetime. The powerful psychological force that Buffett must overcome to execute this strategy is known as the action bias. Humans are wired for action. In our evolutionary past, in the face of a threat or an opportunity, the individual who acted quickly was more likely to survive and reproduce than the one who sat and contemplated. This instinct is burned into our DNA. It feels wrong to do nothing, especially when we are under stress or feel like we are missing out. In the context of investing, this bias is ruinous. When the market is soaring, the action bias screams, "Buy! Get in before it's too late." When the market is crashing, the action bias screams, "Sell! Get out before it goes to zero." The idea of just sitting still, of observing, feels like a dereliction of duty. It feels like passivity. The financial industry is built to exploit this bias. The constant stream of breaking news, the market alerts, the endless commentary. It is all designed to make you feel that you must do something right now. Activity is equated with engagement and seriousness. Buffett's superpower is his ability to consciously and deliberately override this deep-seated bias. He understands that in the world of investing, your results are not correlated with the amount of effort or activity you put in. In fact, they are often inversely correlated. Frenetic trading, constant portfolio adjustments, and reacting to every news story are the enemies of good returns. His ability to sit patiently on cash is not inaction. It is a strategic, high-value activity. He is not doing nothing. He is actively waiting. He is hunting. He understands that the truly great investment opportunities, the fat pitches, as he calls them, are exceedingly rare. They don't come along every day or every week. They come along a few times a decade, usually cloaked in moments of maximum pessimism. To be able to act in those moments, you must have cultivated the discipline to say no to all the mediocre good enough ideas that came before. His patience is not passivity, it is the storing of potential energy. To implement this principle and combat your own action bias, you can create a mental and literal framework called the Opportunity Fund. This is a system for reframing the role of cash in your portfolio from a drag on performance into a high-powered strategic weapon. Step 1. Formalize your allocation. You must make a conscious strategic decision to hold a certain percentage of your portfolio in cash or cash equivalents, like short-term treasury bills. The exact percentage depends on your personal risk tolerance and market conditions, but it could be anywhere from 5% to 25% or even more if you believe the market is extremely overvalued. The key is that this is not just leftover money you haven't gotten around to investing yet. It is a permanent, strategic allocation. Step 2. Segregate and label it. Give this cash a name: the Opportunity Fund, the Dry Powder Account, or the 2008 Fund. This simple act of labeling has a powerful psychological effect. It is no longer uninvested cash, which sounds lazy and inefficient. It is now an asset with a specific and exciting job: to wait for a once-in-a-generation buying opportunity. This transforms your mindset from "this cash is earning nothing" to "this cash holds the option value on every future crisis." Step 3. Define your deployment rules. You must write down, in advance, the specific and extraordinary conditions under which this fund can be used. This prevents you from chipping away at it for mediocre ideas. Your rules might be: I can only deploy this capital when the S&P 500 has experienced a drawdown of at least 20% from its peak. Or, I can only use this fund to buy a company on my pre-approved A list of great businesses if it falls to a price that offers a 50% margin of safety. These rules act as a lockbox, protecting you from your own impatience and action bias. You have pre-committed to a course of inaction, liberating yourself from the need to constantly make decisions. Your job is no longer to find something to do with the money. Your job is to patiently wait for your predefined signal to arrive. This provides the psychological fortitude to do nothing for long stretches and the unemotional clarity to act decisively when the time comes, making financial freedom a more achievable goal. The antithesis to this patient, strategic approach is the dogma of being fully invested at all times. This is the mantra of the 99%. They are taught that cash is trash, that every dollar must be working for you at all times. They fear the drag that cash holdings can have on their portfolio returns during a bull market. This compulsion to be 100% invested has disastrous consequences. First, it forces you to continuously lower your standards. Since you must invest the money, you can't wait for a truly great idea. You are forced to buy mediocre companies at fair prices, or even good companies at high prices. You are constantly choosing from the best of what's available today, rather than waiting for the best of what might be available tomorrow. Second, and far more dangerously, it leaves you naked and vulnerable in a crisis. The investor who was fully invested in September 2008 was not just unable to take advantage of the historic bargains that appeared in the following months. They were often in a much worse position. As the economy cratered, they may have lost their job or faced a financial emergency, forcing them to sell their high-quality assets at the absolute bottom of the market to raise cash. They were forced to liquidate their holdings at precisely the moment they should have been buying with both hands. This is the ultimate financial tragedy, being a forced seller in a panic. The fully invested dogma turns a market crisis from a generational opportunity into a source of personal ruin. It is a strategy that works reasonably well during the good times and leads to catastrophic failure during the inevitable bad times. It lacks resilience, it lacks patience, and it lacks the strategic foresight of a true CEO mindset. It is a plan for participating in the market, not for conquering it. The direct financial connection of valuing inaction and holding cash is the ability to generate asymmetric returns. An asymmetric return profile is one where the potential upside of an investment is many multiples of its potential downside. This is the holy grail of sophisticated investing. The deals Buffett secured in 2008 were masterpieces of asymmetry. His Goldman Sachs investment gave him a guaranteed 10% dividend, his downside was protected, and his base return was high, plus warrants that gave him unlimited upside if the stock recovered, which it did spectacularly. He was in a position to win big if things went well, and to not lose much and still collect a hefty dividend if things just muddled through. These kinds of opportunities only exist when capital is scarce and fear is abundant. They are simply not available during normal market conditions. Therefore, your ability to generate these kinds of portfolio-changing, asymmetric returns is a direct function of your willingness to have been inactive and held cash during the preceding bull market. The cash itself doesn't generate the return. The cash gives you the option times to purchase these incredible opportunities when they appear. The value of this option is immense, but it never appears on a balance sheet until it is exercised. This is the final, powerful link in the chain. Saying no builds your fortress of focus. That focus allows you to operate under the 20-slot rule. This scarcity mindset forces you to stay within your circle of competence. To do that, you use inversion and demand a margin of safety. And you say no to everything that doesn't meet these brutal standards, which allows you to build up a cash position, your opportunity fund. That fund is the key that unlocks the asymmetric returns that are only available in a crisis. It is a fully integrated system, and it all begins and ends with the immense, profitable power of a single word: no. You have just spent this time investing in yourself, acquiring a mental tool of immense power. You have deconstructed the simple two-letter word that forms the bedrock of one of the world's greatest fortunes. You now understand that no is not a word of rejection, but a tool of selection. It is the shield that protects your focus, the filter that enforces your discipline, and the key that unlocks the value of strategic patience. You now possess the blueprint for radical selectivity, the permission to ignore the noise and wait for the signal. This framework is a complete defensive system, designed to protect you from the single greatest threat to your financial success: your own worst instincts and the relentless pressure of a world demanding you do more. But a perfect defense is only half of the equation. A shield is essential for survival, but a sword is necessary for victory. Knowing how to say no to 1,000 mediocre ideas is the first crucial step. But what happens when that one, rare, truly exceptional opportunity finally appears? How do you recognize it? How do you analyze it with the confidence to act decisively, to swing the sword with overwhelming force? The system we have discussed today is a network of interconnected mental models. You have just mastered the defensive architecture, but it connects directly to an equally powerful offensive playbook. The principles of identifying a durable competitive moat, of calculating intrinsic value, of judging the quality of management. These are the mental models that allow you to find the yes that is worth waiting for. The video that is now on your screen is the next piece of that map. It is the link that connects your newfound defensive shield to the offensive sword you will need to build true, lasting wealth. It explores the other side of the coin, the system for identifying the fat pitches that this entire strategy is designed to help you wait for. Most people will stop here, satisfied with their new shield. They will be better off for it, safer and more secure. But the truly committed, those on the deliberate path to financial freedom and an unbreakable CEO mindset, understand that the journey is not complete. They know that a shield is useless without a sword. The decision to click is not a decision to watch another video. It is a decision to complete your arsenal. Continue your ascent.